Today, we've got a mind-blowing topic for you. How Nike, the sportswear giant, manages to pay absolutely nothing in taxes. Yes, you heard that right. Prepare to uncover the secrets and strategies behind Nike's tax game that will leave you astounded. So, grab your favorite sneakers, because we're about to sprint through the world of Nike's tax avoidance tactics. Let's get started. The Nike swoosh logo, although commonly associated with Nike, is not technically owned by the company. In 2020, Nike reported a substantial profit of nearly $3 billion, yet astonishingly, they didn't pay any federal taxes. Nike has employed various strategies to avoid paying a significant portion of their profits in taxes, managing to evade tax obligations between 2018 and 2020, during which they not only paid $0 in taxes but also received nearly $750 million in tax rebates. This is how Nike, through the utilization of a small island in the Atlantic, manages to minimize its tax liabilities to a great extent. Taxes resemble a continuous game of cat and mouse, where businesses constantly search for ways to minimize their tax liabilities through legal loopholes, while governments strive to close these gaps. This ongoing chase has persisted for decades. Companies like Nike are relentless in their efforts to reduce corporate taxes, given the enormous sums at stake. As a result, universal tax strategies are challenging to pin down as they constantly evolve. Nike, for instance, employed baffling yet legal tax strategies between 2018 and 2020, paying no corporate taxes while reporting substantial profits, such as $2.9 billion in 2020. One key aspect involves the distinction between financial reports released to shareholders and those submitted for tax purposes. Companies can manipulate expenditures or investments differently for tax purposes, using methods like depreciation to reduce their taxable income. This enables them to report lower tax liabilities while maintaining favorable financial reports for shareholders. Furthermore, tax credits play a crucial role in reducing tax burdens. Governments encourage companies to invest in certain areas like research and development, manufacturing improvements, or job creation by offering tax credits. These credits directly offset the tax amount owed, incentivizing innovation. Companies like Nike can even carry some of these credits forward for up to 20 years, potentially reducing future tax liabilities. Additionally, refundable tax credits can result in companies receiving rebates from the government, effectively lowering their tax payments. In 2020, Nike not only paid zero taxes, but received a $109 million rebate from the government, thanks to these mechanisms. Furthermore, during the pandemic, the CARES Act inadvertently allowed companies to receive refunds on taxes paid in the previous 2 years, contributing to Nike's tax avoidance strategy. Another lucrative approach involves intellectual property ownership, where Nike doesn't technically own many of its valuable assets like its logo. To gain a deeper understanding of the situation, we need to look beyond the United States and explore genuine tax strategies, such as offshoring. Offshoring simply involves establishing a new segment of a business in another country, not only to sell goods in that market, but also to take advantage of favorable tax regulations. Companies engage in various forms of offshoring, including Nike establishing parent or subsidiary companies in tax havens like Ireland, Monaco, Luxembourg, or Bermuda. These offshoring destinations offer significantly lower corporate tax rates compared to the United States, with Ireland's rate as low as 12.5% compared to the US's 21%. This makes offshoring a highly attractive option for companies like Nike, allowing them to minimize their tax payments. But the complexity doesn't end there. Remember how I mentioned Nike's use of the Nike swoosh logo to dodge even more corporate taxes? Well, Nike doesn't actually own this iconic logo. It licenses it from another entity called Nike International Limited, based in Bermuda. Thanks to a convoluted set of laws in the US, the Netherlands, and Bermuda, Nike can offshore billions in profits from European markets by characterizing them as royalties to the company owning the Nike swoosh and other trademarks. This arrangement allowed Nike to accumulate $6.6 billion in offshore profits by June 2014, taxed at just 3% outside the US, while evading US taxes entirely. Now, you might wonder why countries allow such low tax rates and loopholes. The answer lies in the complex landscape of global economics. In an era of globalization, countries engage in a race to the bottom to attract businesses by offering favorable tax conditions, even if it means reduced tax revenue for governments. The stock price of a company can suddenly drop, prompting CEOs and executives to employ strategies like offshoring for many years. They also invest in safe haven assets to protect their wealth from unexpected events like inflation or global economic instability caused by interest rate hikes. Today, Masterworks, a sponsor, offers everyday investors an unprecedented opportunity to access the secret weapon used by CEOs: museum-grade fine art. Art has a long history of consistent appreciation as an asset class, outperforming the S&P 500 with a 137% return over the past 26 years. With Masterworks, you can invest in artworks from renowned artists like Picasso, Kaws, and Banksy without needing millions of dollars or industry connections. They handle the acquisition and storage logistics while investors can potentially benefit from returns. Masterworks has acquired over 300 paintings and nearly $1 billion in assets under management. Recently, they sold a Cicely Brown piece with a 77% return, marking their 15th consecutive successful sale. Over 800,000 people have signed up. Picture a competition among rival companies, each vying to slash their expenses through any means necessary. Lower costs translate into higher profit margins. This practice is the driving force behind corporations outsourcing manufacturing to countries with low labor expenses and sometimes less stringent labor regulations. However, this race isn't confined to manufacturing or even specific industries. Many nations also engage in a global race to attract businesses by offering minimal corporate tax rates and various incentives that enable companies to retain more of their profits. These governments establish laws and tax rates that might appear puzzling when viewed solely within their own borders. Yet, when examined from a global economic perspective, the reasoning becomes evident. Some governments allocate substantial resources to these initiatives, often outweighing their investment in essential public services. As an example, Nigeria annually spends $2.9 billion on tax incentives to lure companies, which is double the amount it allocates for education, even though millions of girls in the country are not attending school. This practice isn't limited to just a few tax havens. It has a widespread impact on the world. Corporate tax rates have declined significantly, dropping from an average of 27.5% a decade ago to 23.6% today, with signs of this trend accelerating. This pursuit of benefiting companies like Nike, which eagerly moves billions out of the United States or Europe to offshore territories with lower tax rates or peculiar loopholes, is technically legal but raises ethical questions. The ethical dilemma revolves around whether it is morally right for companies to profit from public services while contributing as little as possible in return. Is it ethical for them to report substantial profits while simultaneously reporting no taxable income? Many argue that this creates an unfair advantage in the free market, as everyone should contribute to society in one way or another, including large corporations. Efforts are underway to combat tax avoidance, such as proposing a flat international tax rate of 15%. Nevertheless, there is still a long journey ahead. It seems that the ongoing cat-and-mouse game in the world of taxes will persist indefinitely. Hopefully, we'll witness significant changes in the years to come. While Nike reports substantial profits, the same cannot be said for companies like Twitter, now known as X, which is struggling to break even. Elon Musk has made extensive changes, but the question remains, is it paying off? That's a wrap on Nike's tax secrets. If you enjoyed this video, please hit subscribe and give us a thumbs up. We'll keep bringing you more financial insights, so stay tuned and keep those questions coming. See you next time.